Hello, this is Sheila, tutor for ACCA's Advanced Audit and Assurance at Elite International College. If you're sitting for this paper, you'd know that audit risk or risk of material misstatement questions appear in question 1. The recent examiner's report for the September 2018 sitting states that there will be no marks for speculative risks. Credit is only given for specific risks. So what does the examiner mean? So what are speculative risks? These are imaginary risks that may not necessarily exist given the client's circumstances in the question. What are specific risks? These are current and obvious risks in the scenario. So how does this work? Let's have a look at an audit risk question, Dolly. The requirement says evaluate audit risks. Let's read the scenario. It says you're a manager responsible for the audit of Dolly, a listed company. You're planning the audit for the financial statements for the year ending 31 December 2015. Now that's the question. Is there automatically an audit risk that the revenue and profit will be overstated just because the client is listed? Well, the answer to that is no. To say that there's an audit risk just because the client is listed would be pure speculation. As an auditor, you will have to look for more information to confirm that audit risks exist. So what kind of information are we looking out for? First, is Dolly newly listed or has it been listed for a few years? If newly listed, there's a risk that management may not be familiar with the disclosure requirements. Second, do client results look as if they are improving or deteriorating? If improving, there's no risk of manipulation. If deteriorating, there may be a risk that revenue and profit may be overstated. Now let's read further to find this information. The question says, projected financial statements for 2015 year-end recognize revenue of 138 million. The previous year was 135 million. This shows a revenue increase of 2.2%. It also says profit before tax of 9.8 million, previous year 9.2 million, and this gives rise to an increase in PBT of 6.5%. So what does this mean? It means that there has been a slight improvement in the company's performance. Note that there has not been a deterioration, so that is good. It simply means at this point there is no risk of manipulation. Let's read further. Question says, this year has been successful from a strategic point of view in that Dolly achieved its stock listing in March 2015. Now Dolly's year end is 31 December 2015. So this means that Dolly is newly listed for 10 months now. So which audit risk would be specific here? The answer would be disclosure risk, i.e., risk that the finance director may not be familiar with the disclosure requirements. The question also says, and in doing so raised a significant amount of equity finance. Let's think about this for a bit. If you have invested a significant amount of money in this company, would you be happy if revenue only increases by 2.2% and PBT increased by only 6.5%? The answer is unlikely. So therefore, there is a risk that management may be under pressure to show better results in this year's financial year because institutional investors are likely to want dividends. So what are the risks for Dolly? It is newly listed, so the risk would be that the finance director may not be familiar with disclosure requirements. Which disclosure requirements? IAS 33, IFRS 8. Results are also mediocre. Therefore, there's the risk that management may be under pressure to show better results in this financial year. So for Dolly, are these risks speculative or specific? For Dolly, both risks are specific and not speculative. The examiner warns that speculative risks do not attract credit. So you have to actually read the question very carefully to identify only specific risks for your answers. Now let's have a look at another question, Z. This is also an audit risk question. Question says, the Z Communications Group is an audit client of your firm with a financial year ending 31 December 2016. Z is a listed entity. So question, is there a risk of inadequate disclosure? Well, this risk will only exist if the client is newly listed. The question says, Z is one of the firm's largest client. From here, we can see Z is not newly listed. Is there a risk of manipulation? Well, let's study the results in the question. You have been given information regarding the revenue. Last year is 12 months figures and this year is 8 months. So what we'll have to do is we will have to gross up the revenue to 12 months. And 198 million grossed up to 12 months comes up to 297 million. When you compare 297 million with the previous year, that amounts to a revenue increase of a whopping 35%. So, is there a risk of manipulation? The answer would be unlikely, because Z's results look like they are improving and improving by quite a bit. So how will you write out the answer? We have looked at two questions, Dolly and Z. I'll start with Dolly. So for Dolly, put a little subheading, newly listed, and state the story that this is the first set of financial statements produced since Dolly became listed. Next, explain the risk. Risk that the new finance director may lack knowledge and experience of the reporting requirements for listed entities, for example, IAS 33 on earnings per share, IFRS 8 on operating segments for the first time. Consequently, there may be incomplete or inaccurate disclosures in respect of these standards. 1 mark for the risk. Next, another subheading, results not impressive. The flotation raised a significant amount of equity finance, so there will be new shareholders who will want to see strong performance, especially the institutional shareholders in the expectation of a dividend payout. That would be the story. In this case, we would be able to add on some preliminary analytical procedures. And the comment here would be the projected financial statements for 2015 show 2.2% increase in revenue and 6.5% increase in profit before tax. The marking scheme states that there is half mark for every single calculation, up to a maximum of 5 marks in question 1. But in order to get this half mark, it would also be very important for you to interpret the percentage increases. So here we'll add in another comment that says the increase is very mediocre considering the significant injection of equity finance. Only with the interpretation do you get the marks for your analytical procedures. Next, risk that management may be under pressure to show better results this year. Consequently, revenue and profit may be overstated. So what do we do for Z? Well, we saw earlier that Z is not newly listed, so there is no disclosure risk. The results are very good, so there's no risk of manipulation. I'm hoping that this little video helps you to see that no two questions are alike. Read carefully the details in the question. Identify specific risks. Do not include speculative or imaginary risks. Till next time, cheerio!